When most people hear the phrase short the market, they imagine something cinematic. They imagine one brilliant, cold-blooded contrarian standing alone against the world, betting on collapse while everybody else is still buying champagne and congratulating themselves on the endlessness of prosperity. They imagine the big short. They imagine genius, nerve, and a very dramatic payday. There is truth in that picture. There is also a dangerous distortion in it, because what made the greatest crisis investors rich was not mainly that they knew how to press the down button while everyone else was pressing up. What made them rich was that they understood something much deeper than the crowd understood. They understood structure. They understood that if you know how the system breaks, you do not need to guess every headline. You need to know which promises are weakest, which incentives are rotten, which balance sheets are pretending, which lenders are vulnerable, which narratives depend on perfect conditions, and which assets can be owned, shorted, avoided, or bought later once fear has done its work. That is the real story. The public remembers the short. The serious investor remembers the architecture. I want to begin there, because a great many people hear about Michael Burry or 2008 or housing swaps and think the lesson is that smart investors make money by predicting doom. That is not the full lesson. The full lesson is that great investors make money by understanding how a system prices risk wrongly, how long it can stay wrong, what can force it to admit the error, and how to survive the waiting period without getting destroyed. That is a very different skill. And it is why I have always thought ordinary people ask the wrong first question about shorting. They ask, how do I make money when stocks go down? The more useful question is, how do I position myself when upside is already crowded, downside is rising, and the system is more fragile than the story around it? That question opens a much richer conversation, because shorting is only one possible answer. Sometimes it is the right answer, sometimes it is the wrong answer, sometimes the better answer is to sell. Sometimes it is to hedge, sometimes it is to buy volatility, sometimes it is to own the businesses that collect tolls during the crisis. Sometimes it is simply to survive the liquidation so that you can buy the aftermath. That is why I do not like the way people romanticize shorting. Shorting is not the core skill. Downside literacy is the core skill. If you have downside literacy, then shorting becomes one instrument in a larger toolkit. If you do not have downside literacy, then shorting is just a loaded weapon in nervous hands. Let me explain what I mean. In normal investing, people are taught the cheerful side of markets. Buy a stock, wait for it to rise, own a business at less than you think it is worth. Let time help you collect compounding. All of that is sound enough. I have spent most of my life believing that buying good things sensibly and holding them with discipline is the best road for most people. That remains true, but it is not the whole map. Markets rise over long stretches, yes, but they do not rise in straight lines, and they are never as healthy as they look at the top. Every bull market eventually produces a kind of hypnosis. The public begins to think rising prices are proof of soundness, cheap credit begins feeling normal, fragile companies begin looking bold, leverage begins looking like intelligence, and risk gets hidden inside more pleasing words: disruption, innovation, liquidity, growth, optionality, transformation, efficiency. Every cycle invents its own flattering language for the same old disease. Easy money makes weak things look strong. That is the first law of market decline. Once you understand that, you begin seeing why some investors spend so much effort studying what can go wrong. They are not gloomy by nature. They are structural by nature. They know that if easy money, high confidence, or soft standards are holding up the price of an asset, then the real story is not how high the asset can float. The real story is what happens when the air begins escaping. That is where fortunes are made and lost. The public hates this kind of thinking because it feels ungenerous. It feels like rooting against the world. But serious investors are not paid for emotional loyalty to the crowd. They are paid for seeing what the crowd is refusing to see. Michael Burry was not magical because he hated houses. He was dangerous because he knew the mortgages were worse than the bonds pretending to be built from them. He saw the payments, the incentives, the fraud, the refinancing assumptions, the delusions about home prices, and the absurdity of believing that millions of weak loans could somehow become a strong structure by being sliced into tranches and wrapped in better language. That was the real skill. He understood that when a system requires the weakest assumptions to stay true indefinitely, it is already unstable. That is what I mean by downside literacy. And once you learn to think that way, shorting is no longer a stunt. It becomes a way of expressing a structural view. Now, let us talk plainly about what shorting actually is, because too many people hear the term and mistake the mechanics for the intelligence. In the simplest form, shorting means you borrow shares, sell them, wait for the price to fall, buy them back cheaper, return them, and keep the difference. Simple enough. The trouble is that the simplicity is deceptive. A stock can only fall to zero, but it can rise far beyond the level where you first shorted it. That means your upside is capped, but your downside is potentially unlimited. Right away, you should see the problem. Shorting is not like buying a mispriced asset where time can often help you if the business is sound. Shorting is a race against price, crowd emotion, central bank policy, narrative momentum, and sometimes madness itself. That is why being right is not enough. You must be right about structure and not die on timing. That is the whole short seller's tragedy. Many brilliant investors saw bubbles long before they popped. Some went broke being early. Some were forced out just before vindication. Some were correct in theory and destroyed in practice. The market does not pay you for being right eventually. If your financing, your margin, or your psychology cannot survive the path, that is why I think the most important lesson in shorting is not how to borrow a stock. It is how to respect path risk. Path risk is what crushes proud investors. You short an absurd company at $50 because the business is nonsense. It goes to 70, then 90, then 120. You are still right about the nonsense. The market does not care. Your broker calls margin requirements rise, borrow costs rise, other shorts get squeezed, a cult forms around the stock. The wrong story becomes stronger precisely because it rose. By the time the collapse finally comes, you may be gone. That is why I say downside literacy matters more than shorting technique. A good short seller is not a pessimist with a broker account. He is an allocator who understands fragility, position size, timing windows, financing risk, and the psychology of crowds. He knows that a bubble can get dumber longer than his emotional stamina can. He knows that the cleanest short is not always the ugliest business. Often it is the ugliest capital structure, the weakest refinancing profile, the fakest margins, the most fragile customer base, or the business most dependent on conditions that no longer exist. The stock price is the last thing he studies. The mechanism is what matters. This is why I think the public learns the wrong lesson from famous short sellers. They think those men made money by being negative. They made money by understanding system failure better than other people understood system success. That is a very different edge. And if you want to know whether ordinary investors can participate in that edge, the answer is yes, but not always in the glamorous way. They imagine there are at least 4 broad ways to act when you believe markets or sectors are dangerously overvalued. The first is direct shorting. This is the most dramatic and often the most dangerous. Borrow the shares, sell them, hope to buy lower later. This can work. It can also ruin you if you are early, over-leveraged, or careless about position size. I do not believe direct shorting is a natural home for most ordinary people. It asks too much emotionally, and structurally the losses can grow the wrong way. The borrow can change, the broker can force your hand, the crowd can become irrational. A central bank can rescue a narrative you thought was finished. There are simpler ways to survive an overvalued market than putting yourself in front of a theoretical infinite loss. The second is inverse exposure through vehicles designed to rise when markets fall. This sounds safer, and in one sense it is. You can lose only what you put in. You are not borrowing shares yourself. But these instruments have their own traps. Many reset daily, some decay over time, some behave differently from what inexperienced holders expect if volatility becomes the main feature rather than a clean downward trend. They can be useful for short-term positioning, tactical hedging, or brief defensive windows. They are often poor companions for long periods. If you do not understand daily reset mathematics, you should not pretend you do. The third is the oldest and least glamorous approach. Sell the expensive things and wait. This is the form of shorting the public respects the least, because it feels too passive. Yet it has made many people extremely wealthy precisely because it does not require them to borrow to survive margin calls or to explain themselves to a broker when the market turns theatrical. If you believe an asset is wildly overvalued, you can reduce or eliminate exposure. That may not create profits from the fall in the direct way a short does, but it preserves capital, preserves sanity, and preserves optionality. Optionality matters more than most investors realize. The person who held cash into a collapse did not look brilliant at the top. He often looks brilliant in the aftermath. The fourth approach is the most underrated of all. Do not merely bet against the bad position for what breaks, what gets repriced, and what can be bought cheaply when the bad finally cracks. This is the approach I trust most, because the rich money is often not made by shorting the final 10% down. It is made by having the balance sheet, the patience, and the clarity to buy the right assets from forced sellers after the system begins admitting what the short seller already knew. That is where the big short story misleads the public most. They think the movie was about making money on the collapse. For a great allocator, the real question is always what the collapse makes newly purchasable. That is the real feast. Every collapse creates 2 classes of winners. The first class gets paid because they were against the weakness. The second class gets rich because they knew what would be cheap afterward. The first class is dramatic. The second class usually becomes far wealthier. That is why I think ordinary investors should spend less time fantasizing about nailing the perfect short and more time learning the anatomy of fragility, the discipline of risk reduction, and the patience of post-panic buying. You do not need to be a hero in every act. Often the best role is to stay liquid while the theater burns. Now, I want to talk about margin, because margin is the private executioner of many good ideas. People hear that shorting requires a margin account and treat that as a technicality. It is not a technicality. It is the broker's claim on your future obedience. If your position moves against you, the broker can demand more collateral. If you cannot provide it, the position can be closed. Notice what has happened here. Your analysis may still be right. Your capital structure may still kill you. This is the lesson many smart people learn late and painfully. A correct view with the wrong financing is still a bad trade. I have always believed that the deepest advantage in markets is not brilliance. It is survival. The investor who survives error, delay, and volatility can still use his intelligence later. The investor who is forced out by leverage turns his good ideas into somebody else's opportunity. That is why I am much more interested in how an investor carries a bearish thesis than in the thesis alone. Can he size it small enough? Can he wait? Can he live through being early? Can he survive a squeeze? Can he distinguish a narrative bubble from a structural insolvency problem? Can he tell the difference between a fad stock and a refinancing accident? These things matter more than confidence. The crowd loves confidence. The market loves survivors. This is why I also want to warn against another mistake. Many people think the purpose of learning about shorting is to become more aggressive. For most people, the opposite is true. The true gift of understanding shorting is that it makes you more selective, more respectful of downside, and harder to fool with pretty stories. You begin seeing how leverage sits inside the market. You begin noticing when a company's equity value depends not on durable cash flow but on continuous belief. You begin asking whether a business can survive a more expensive world. You begin seeing that the line between a growth company and a financing vehicle is sometimes much thinner than the crowd thinks. That is an enormous advantage, even if you never short a single share. It means you stop buying fragility at the top. That alone can save you a fortune, in that sense. Learning how short sellers think is one of the best defensive educations an ordinary investor can receive. It teaches you how to examine the underside of a story, who is funding it, what assumptions are embedded in it, what happens if rates stay high, what happens if the customer weakens, what happens if the next round of capital is more expensive, what happens if gross margins compress, what happens if inventory turns against them, what happens if the accounting quality is lower than the charisma quality. These are the right questions. They are boring questions. They make money. Now let me say something about inverse ETFs and similar products, because they are often marketed to ordinary people as though they are a civilized way to short without the danger. They are better than naked ignorance. They are not magic. If a fund is designed to move inversely on a daily basis, then the path of the market matters. Volatile, choppy declines are not the same as smooth declines. Reset mathematics matter. Time matters. The longer you hold some of these vehicles, the more likely you are to discover that direction alone is not enough. This does not make them useless. It makes them specialized. I think of such tools the way I think of a chainsaw, useful in the right hands for the right job over the right interval. Absurd as an all-purpose household utensil, ordinary investors should remember that. The existence of an easier vehicle does not eliminate the need for judgment. In fact, easier vehicles often create more careless judgment. That is another hidden cost of financial innovation. The barrier to entry falls faster than the barrier to wisdom. Now let us discuss the most underrated bearish strategy of all, which almost never makes for good movies. Raise cash before you need to. The crowd treats cash as dead money during booms. That is because the crowd thinks only in the language of participation. Participation feels virtuous at the top. Participation gets expensive at the bottom. A person holding cash during euphoria looks timid. A person with cash during forced liquidation looks powerful. That is not of all difference. I have always found it remarkable how eager people are to call cash cowardly in the final stages of a mania. What they really mean is that cash does not flatter them while everything is going up, but finance is not about flattery. It is about terms. And the terms offered to a liquid investor after a crack begins are often much better than the terms offered to a fully invested optimist before it. That is why I say the simpler way to short overvaluation is often to refuse to own it and prepare to buy later. This sounds too dull for many people, so they ignore it. And then they spend the crash learning why dullness is underrated. I want to say something here about timing, because people tie themselves into knots over it. They ask when exactly to short, when exactly to sell, when exactly to buy back, as though the great money in markets belongs to the person who catches every turn perfectly. It does not. The great money often belongs to the person who is directionally right, sized sensibly, liquid enough to endure noise, and clear enough to distinguish regime change from ordinary volatility. That is a much more humane standard. It is also much more realistic. You do not need to catch the top tick. You need to know when the assumptions holding valuations together have become too fragile. You do not need to buy the exact bottom. You need to know when fear has begun forcing sales that have more to do with liquidity than long-term value. That is the real edge. It is a structural edge, not a stopwatch edge. Now let me bring this back to you in the bluntest possible way. Can regular investors short the market? Yes, but the most useful version of that question is not whether you can borrow shares and mimic Michael Burry. The most useful version is this. Can you think like someone who understands downside? Can you recognize when a story depends on cheap money, easy funding, forgiving customers, and blind confidence all at once? Can you stop calling overexposure prudence just because it is popular? Can you reduce or reverse exposure when prices stop making sense? Can you hold some cash without feeling ashamed? Can you survive until forced selling hands you better opportunities? Those are the real skills. They are available to ordinary people. They are also rare because most people would rather participate in the crowd than study the failure mode of the crowd. That is why true downside literacy has such high returns. It is not crowded. Everybody wants upside. Very few want to think honestly about what can go wrong. That is why the people who do often look strange before they look brilliant. Markets dislike early pessimists. History tends to rehabilitate them later. I do not think the goal should be to become permanently bearish. That is another rookie mistake. Permanent pessimists are as unhelpful as permanent optimists. The goal is to become conditionally skeptical, to know when enthusiasm has outrun structure, to know when the balance sheet matters more than the story, to know when the right move is aggression and when it is defense, to know when the better trade is not the short itself, but the cash you carry into the aftermath. That is how mature investors think. They do not fall in love with bearishness. They respect it as one chapter in the broader discipline of capital allocation. So if you ask me what ordinary investors should take from the great short sellers, it is not courage alone. It is this. Look where the system is weakest. Respect the path, not just the thesis. Never let leverage bully you out of a good idea or seduce you into a bad one. Remember that the crowd can remain delusional longer than you can remain emotionally comfortable. And above all, remember that the crash is not the end of the story. It is the moment when ownership begins changing hands. The public watches the collapse. The prepared investor watches what the collapse puts on sale. That is the difference between making money from panic and becoming rich through it. If I could leave you with one sentence, it would be this. The point of learning how investors short the market is not to teach you how to hate rising prices. It is to teach you how to recognize fragility, protect capital, and stand ready. When the system finally offers wonderful things at terrible prices, that is the real education. And if you learn that, you do not need to become Michael Burry. You simply need to stop being the person who always arrives after the lesson has already been paid for by someone else.